What was wrong with the data in your view, Michael?
I completely agree with you, Steve. I think when you have a falling unemployment rate, but you have wages going up, that's the recipe for a soft landing. So I think it's more just selling based on massive profits that have occurred over the course of the last month or two, because the numbers that came out, and in fact, the numbers that came out actually then prompted Federal Reserve officials to even become more aggressive in their comments about increasing the size of the cut that they plan on making in interest rates. So I think the numbers were great, and I don't think investors should read too much into last week. That was just an off week, I think.
I beg to differ with both of you slightly, because I don't think it was the data that came out. It's the revisions, isn't it? If you look at the numbers that we had from prior months, they're all being revised lower, and that's the problem. The data may have looked okay Friday, but we don't know if the 142,000 is actually the number. Is it sub 100,000 on the job print?
Yeah, you never know, because they go back and revise the numbers. And the market at this point, Karen, with markets as high as they are, they're very emotion driven. And if you have numbers, that's one reaction. Then you have revision of numbers, that's another reaction. Then you have the comment of the Federal Reserve on the numbers and on the revised numbers. That swirl of emotion that is what causes the volatility that investors are enduring right now.
Michael, I feel you're our counsellor and our therapist, and we're using you to argue between ourselves, because I disagree with Karen on that one. I think that was even better for the market, because what it got was, it got the language which then you talked about there from the Fed members saying, look, things are okay, but we can move quicker if we need to. And it was the so-called dovish cut or hawkish cut that everyone focuses on. I think now it's almost nailed on a dovish cut in terms of language, not only from the likes of Waller and Williams and others, but also, of course, from Jay Powell.
Yeah, our thesis was 0.75%. Then we went to 0.5%, but we're back to 0.75%. I would not be surprised in September. I would not be surprised if they jumped all the way to 50 basis points. And if they did that, that would be considered, on one hand, a very positive sign that the Federal Reserve is willing to do what they need to do to support jobs growth. Of course, some will be concerned that the Fed knows something that nobody else knows. But I think the Fed at this point is ready to get out ahead of this. And so I think 75 basis points is probably the likely outcome over the course of the next 3 to 4 months.
Michael, just to the point around rate cuts and what we're shaping up for, I was looking at an ING report over the weekend, and they were saying, look, they have a low conviction call too for 50 basis points. And that's a problem, because how do we think about it? Is it because inflation has retreated, or is it because the lead indicators are so negative now that the Fed is looking at? And that would be a problem, wouldn't it, for some market participants that have been concerned about the slowdown in the States?
Yeah, I think the 50 basis points is the speculation is all about that the leading indicators are showing that there's a sort of recessionary ball coming down the road that we have to try to avoid. So I think that that's really the greatest concern that investors have. It's kind of the whole soft landing versus shallow recession sort of argument. But again, Karen, if you look at the numbers, I mean, you still have an unemployment rate that's still very, very low on a historic basis. You still have interest rates that are very low on a historic basis. Company earnings have been pretty good so far. And the Fed is sitting here saying, well, if anything gets in our way in terms of a soft landing, we're going to take action. I don't know. That seems fairly positive to me.